stop trading until you learn this rule. I mean that. If you've been following my talks, you'll remember the previous video on 3 ways to identify a trend reversal early. That lesson was about reading the market's language before it shouts. But this is about knowing when not to trade at all. You see, every losing trader I've ever met has one thing in common: they couldn't wait. They just had to be in the market. They thought being active meant being smart. It doesn't. It just means you're impatient. Now let me ask you something. Have you ever looked at a chart and thought, well, it's moving, I better get in before it's too late? That feeling, that rush, that's the death of most accounts. The rule I'm talking about today separates the professionals from the public. And it's simple. Don't trade when there's nothing to trade. Sounds obvious, doesn't it? But it's the hardest thing in the world to do. The market doesn't pay you for effort. It pays you for waiting for the right moment and acting only when everything lines up. If you don't have a clear line of reasoning, a clear setup that fits your tested method, you're gambling, not trading. Let me tell you, when I first started, I thought I had to be in the game every day. I'd look at the tape, and if I didn't make a trade, I felt like I was missing the action. I didn't realize that staying out is a position too. The hardest part of trading isn't taking a loss. It's doing nothing when the market tempts you with noise. That's what I mean by stop trading until you learn this rule. Now you might be thinking, but Jesse, how do I know when not to trade? The answer lies in your preparation. If you've studied your charts, if you've read the tape, and you can't see a clear direction, don't try to invent one. The market's story isn't always written yet. You can't force a chapter that hasn't been printed. I used to sit for hours, sometimes days, doing nothing but watching. People around me would trade every squiggle on the board. They'd laugh when I stayed still. But when the time came, when the trend revealed itself plain as day, I was ready and they were exhausted. The market rewards patience, not participation. Do you know why most traders lose? Because they can't sit tight. They don't understand that the best trades happen once or twice in a month. Not every morning before breakfast. The amateur wants to eat 3 meals a day from the market, but the market doesn't serve on a schedule. Remember what we discussed in that previous video on trend reversals, how the earliest signs of a turn are subtle, quiet, almost invisible. That same patience applies here. If you can wait long enough for the market to show its hand, you'll never need to chase. The moment you chase, you've already lost your edge. Another question for you. Do you keep trading because you're certain, or because you're afraid to be left out? That's a tough one. Most won't admit it, but fear of missing out drives more trades than strategy ever did. You see a candle break a level, you think, this is it. But if you haven't confirmed the volume, the context, the broader trend, you're just reacting. And reaction is emotional. Trading should never be emotional. I learned this rule the hard way. Every time I broke it, I paid tuition to the market. That's what I call losses. Tuition. You're always paying for your education in this business. The only difference is whether you learn the lesson or not. When the tape is dull, when prices drift without conviction, that's when you should tighten your grip on your capital. Because dull markets breed false signals. They make you think something's happening when it's just the market breathing. Don't mistake noise for opportunity. A good trader's job is to wait until the odds line up so well that the trade almost feels obvious. That's when you act, and that's when you make your money. Every other time, you protect it. You'll never go broke waiting for the right moment, but you'll go broke trying to trade every moment. And let's be honest, how many times have you entered a trade just because you were bored? Maybe the day felt slow, maybe your last trade stopped out and you wanted revenge. You told yourself, just a small position this time. But that's how it starts. The small, harmless trade becomes a habit, and habits become ruin. The market punishes neediness. Trading isn't about being right all the time. It's about being selective. You can be wrong half the time and still come out ahead if your timing and discipline are sound. That's why this rule matters. It protects you from yourself. The best money I ever made came from trades I waited weeks for. The worst came from trades I entered because I felt I had to do something. There's a strange kind of comfort in activity. It tricks the mind into thinking progress is being made, but markets don't care about your feelings. They only respond to structure, volume, timing, and trend. When you learn to see that, you start thinking differently. You start to understand that wealth isn't built from one lucky move, but from a series of disciplined decisions. And just as many disciplined non-decisions. You protect your capital as fiercely as a general guards his last battalion. Because that's what it is. Your capital is your army. You send it into battle only when victory seems almost certain. And if the battlefield is unclear, you stand still. You wait. You let the other soldiers exhaust themselves first. The tape will tell you when the tide has turned. It always does. But only to those who can listen quietly enough to hear it. Do you remember how we talked about spotting reversals before they're obvious? Well, this rule is the other side of that coin. Sometimes the smartest trade is the one you don't take. The market whispers before it shouts. And if you can't hear the whisper yet, you've got no business making noise yourself. Patience isn't passive. It's preparation. Every moment you spend out of the market, you should be sharpening your tools, studying price action, refining your system, understanding where the next big move might form. When that moment arrives, you won't need to guess. You'll recognize it. You see, trading is a business of waiting. Waiting for the right signal, the right price, the right moment when risk and reward finally tilt in your favor. Until then, you guard your resources, you keep your mind clear, and you refuse to be seduced by movement that means nothing. The best traders wait for the market to show its hand. That's a rule written not in theory, but in the blood and sweat of every serious operator who ever stood before a price chart or watched a ticker tape spin. You can't rush the market into revealing its direction, any more than you can rush the seasons to change. The market moves when it wants to move, not when you want it to. And the traders who survive, the ones who last long enough to make real money, are those who've learned how to wait. When I say wait for the market to show its hand, I mean this: don't act until the market itself tells you where it intends to go. Most traders lose because they're trying to outguess it, to predict instead of confirm. They jump in because they think they know what's coming next. But the market doesn't pay you for guessing. It pays you for understanding its behavior. Have you ever watched a poker game? The rookie tries to bluff on every hand, thinking he can outsmart the others. The professional waits. He studies his opponents, their patterns, their tells, their rhythm, and when the right card falls, he moves with conviction. That's exactly what you must do with the market. Price action, volume, and structure. That's the hand the market plays. Every move it makes is a clue, a gesture, a signal. The amateur reacts too soon, but the professional waits for confirmation. If a stock is trending upward but the volume is fading, it's not showing strength, it's showing exhaustion. If price breaks a key level but quickly reverses, that's not a breakout, that's a trap. The best traders don't chase these false moves. They let them unfold. They let the story play out until it's clear who's winning, the buyers or the sellers. Now ask yourself, how many times have you entered a trade too early, only to see it reverse the moment you clicked buy? Every trader knows that feeling. You spot what looks like a strong move, you don't want to miss it, and suddenly you're underwater before you can even think. That's what happens when you act before the market has shown its hand. You're trading what you hope to see, not what's actually there. The truth is, the market always telegraphs its intentions. But it does it quietly. You've got to learn to read the subtleties, the hesitation before a breakout, the acceleration after a breakout holds, the change in rhythm when volume expands at the right moment. You'll never see these things if you're too busy clicking buttons. The trader who's always in a position is never in the right one. When I was younger, I made that mistake often. I wanted to be active. I thought trading meant always having a stake, always making a move. But the best trades of my career were the ones I waited for. The setups that took weeks to form, that tested my patience, that made me doubt whether the move would ever come. Those were the trades that paid. You see, the market rewards the observer, not the aggressor. You can't force opportunity, you can only recognize it when it arrives, and it doesn't arrive often. The big moves, the ones that make your month or even your year, are rare. They don't happen every day, and they don't announce themselves with fireworks. They start quietly, with a subtle shift in trend, a change in volume, a pattern that looks ordinary until it's not. That's why you have to wait. You wait for the price to act in harmony with your setup. You wait for confirmation that the tide has truly turned. Until then, you sit tight. Do you remember how we talked in that previous video about identifying trend reversals early? Well, this principle ties directly to it. The skill of spotting a reversal is worthless if you act before the market confirms it. Early recognition is only valuable when paired with discipline. The difference between a good entry and a premature one is often just a few bars, but that gap can mean the difference between profit and pain. Patience in trading isn't passive. It's one of the hardest forms of discipline you'll ever practice. Waiting doesn't mean doing nothing. It means watching closely, studying every move, preparing mentally and strategically for the moment when your setup finally clicks. The waiting period is when you refine your plan, your entry, your stop, your target. You prepare so that when the market finally shows its hand, you can strike without hesitation. And when that moment comes, you'll feel it. The chart aligns, the pattern confirms, and everything you've been watching falls into place. That's when you move, not before, not after. The amateurs are always too early or too late because they don't trust the market to tell them what to do. They let their emotions decide, fear and greed. Those are the enemies of patience. Ask yourself, are you waiting for the market, or are you forcing it to give you something it's not ready to give? Because the difference between those two mindsets determines your outcome over the long run. One leads to control, the other to chaos. A trader who waits for confirmation isn't weak or hesitant. He's confident. He knows that his capital is his most precious asset, and he won't risk it without clear evidence that the odds are in his favor. The market gives clues, not certainties. But those clues become clear to the trader who's patient enough to let them develop. You must remember, every great move in the market has a moment when it becomes undeniable. That's when the market has revealed its hand. The trend is clear, the momentum is confirmed, and the crowd begins to see what you've been waiting for all along. If you enter before that moment, you're guessing. If you wait for it, you're trading with the flow. There's an old saying, it's not the buying or the selling that makes money, it's the waiting. That's as true today as it was 100 years ago. Waiting for the market to show its hand means trusting the process, respecting the rhythm of price movement, and accepting that time, not impulse, is the key to consistency. Staying out of the market is a valid trading position. Most traders never truly understand that. They think trading means constant action, constant buying and selling, always being involved, always doing something. But the truth is, the best traders spend more time not trading than trading. The market doesn't pay you for effort. It pays you for timing. And sometimes the best trade you can take is no trade at all. You see, when you're sitting in cash, you're not out of the game. You're simply waiting for the odds to stack in your favor. Every great operator I've ever known understood this deeply. They didn't look for trades every day. They waited for the market to come to them. The amateur tries to force opportunities, like a fisherman thrashing the water hoping to scare up a catch. The professional knows that the fish come when they come, and his job is to be ready when they do. Let me ask you, how many times have you taken a trade just because you felt like you had to be doing something? Maybe you saw a small move and thought, it's better than nothing. Maybe you felt anxious sitting on the sidelines while everyone else seemed to be making money. That feeling, that restlessness, is the enemy of good trading. When you can't sit still, when you feel the need to be in no matter what, that's when mistakes happen. The market punishes impatience. every single time. There's this dangerous illusion that being active means being productive. It's the same illusion that drives people to overtrade, to jump in and out of positions without a plan. But the market doesn't care about your need for excitement. It only respects discipline. The moment you realize that staying out is a legitimate decision, just as much as buying or selling, you start thinking like a professional. When you stay out, you're protecting your capital, your energy, and your clarity. You're waiting for the right setup to show itself. You're giving yourself the space to see the bigger picture. Most traders lose not because their strategy is bad, but because they don't give it time to work. They enter trades that don't meet their own criteria just because they're bored. Think about it. If you trade out of boredom, what kind of outcome do you expect? The market is a living organism. It breathes, it pauses, it digests information. There are moments when it's trending strongly and moments when it's lost in confusion. A smart trader knows which phase he's dealing with. When price action is choppy, when the trend is unclear, when the volume dries up, that's not the time to be brave. That's the time to stand aside. You don't wrestle with a market that's undecided. You wait for it to show direction, and then you act. Staying out also keeps your emotions in check. Every trade you take burns mental energy. You might not notice it at first, but after a few impulsive entries and exits, your decision-making starts to blur. You begin chasing moves, adjusting stops too tightly, jumping from one setup to the next. Before long, you're not trading a plan, you're trading your mood. Sitting out resets that. It lets your mind cool off, lets your judgment recover. Do you remember in that previous video where we talked about identifying trend reversals early? That's another reason staying out is powerful. When you step aside during uncertain conditions, you give yourself room to see those subtle signs of change. If you're buried in trades, your attention is narrow. You're focused on protecting your position, not on observing the market. But when you're flat, detached, patient, you can see things others can't. The shift in momentum, the volume swell, the quiet warning before a turn. That awareness only comes when your capital isn't tied up in noise. There's a saying among old traders, don't just do something, sit there. It sounds strange, but it's the essence of professional behavior. Because sitting there, waiting, observing, analyzing, is doing something. It's preparation. It's discipline. When you're out of the market, you can evaluate your past trades, refine your system, study new setups. Every great trader uses quiet periods for sharpening the axe, not swinging it wildly. Ask yourself, what's worse, missing a trade or losing money on a bad one? The answer is obvious, yet most traders act as if missing out is the greater sin. They can't stand to see price move without them. But here's the truth, missing a move costs nothing. Losing on a poor setup costs capital. You can always catch the next wave, but only if you have funds left to ride it. Staying out preserves that flexibility. It's your insurance policy against recklessness. And let's not forget, markets are not obligated to give you opportunities every day. Some days are designed to trap traders. Some weeks, even months, unfold in tight ranges that grind accounts down. The smart trader recognizes this and steps aside. He doesn't try to force a living out of dead price action. He waits for volatility, for momentum, for confirmation that the game is worth playing. When you treat being flat as a position, you start managing risk differently. You stop equating movement with opportunity. You learn to value silence on the chart as much as action. It's a shift in mindset. From wanting to trade well. That's when your whole approach changes. You stop chasing and start planning. You stop reacting and start observing. Sometimes the greatest show of strength is restraint. The ability to do nothing when every impulse inside you screams to act. That's what separates the amateurs from the professionals. The crowd trades constantly because they think that's what traders do. The elite trade selectively because they know that's how you survive. Capital in your account is potential energy. Every dollar you don't risk unnecessarily is fuel for the next real opportunity. If you waste it on noise, you'll have nothing left when the real move arrives. So when the market looks messy, When direction is uncertain, when setups are unclear, remember, being in cash is not weakness, it's wisdom. Never trade when the market's direction is unclear. That's a rule most traders hear, but few truly obey. They see a chart moving sideways, or a price jumping back and forth in a tight range, and they convince themselves there's an opportunity hidden in the noise. But there isn't. When the market doesn't know which way it wants to go, your job isn't to guess. Your job is to step aside. The market pays the trader who can wait until the picture sharpens, not the one who trades out of confusion. You can't make sense out of chaos. If the price is moving without conviction, if it's shifting directions every few hours, then there's no edge to play. Every trade you take in such a condition is a coin toss dressed up as strategy. You might get lucky once or twice, but luck is not a method. Have you ever noticed how, when you trade during unclear conditions, the market seems to turn against you almost instantly? That's not bad luck. That's the market reminding you that uncertainty is not your friend. Clarity in the market comes from structure. You should be able to look at a chart and say, the trend is up, or the trend is down. If you can't, that means the market itself hasn't decided. And if it hasn't decided, why should you? The biggest losses come when traders try to predict instead of waiting for confirmation. They see a few green candles and think the bull is charging, only to be caught in a sharp reversal. The truth is, the market doesn't hide its intentions. It simply takes time to reveal them. The tape always tells the truth, but only to those patient enough to listen. Now let me ask you, how many times have you felt that itch to trade even when the chart looked messy? You tell yourself, I'll just grab a quick scalp. But there's nothing quick about trading uncertainty. Every second you're in that position, you're fighting a war with no defined enemy. You're not trading price action, you're trading anxiety. The uncertainty of the market infects your mind, and you start reacting to every tick, every candle, every whisper of movement. That's not trading, that's survival mode. When the market's direction is unclear, you have to think like a sniper, not a soldier in the open. You find your target, you line it up, and you wait for the right shot. You don't fire into the dark hoping to hit something. That's what amateurs do. They confuse activity with skill. Professionals, on the other hand, know that no movement can be as powerful as the right movement. The absence of a trade is a position in itself. And let's be honest, indecision in the market is usually a sign that bigger players are positioning themselves quietly. They're absorbing, distributing, waiting for liquidity. When you jump in during that phase, you're walking straight into their trap. You think you're being clever by catching small swings, but all you're doing is donating your capital to those who are waiting for the same clarity you ignored. Do you remember in the previous video, when we talked about identifying trend reversals early? That lesson connects directly to this rule. You can't spot a reversal in an unclear market because reversals only occur when a prior trend exists. If there's no defined direction, there's nothing to reverse. You're just dealing with noise, and noise can't be analyzed. It can only be avoided. The smart trader reads the market like a book. When the story is confusing, he doesn't keep guessing what happens next. He waits for the next chapter to be written. Each move tells part of the narrative, and until the story makes sense, he stays out. That's discipline. The impatient trader, though, jumps in during the first few pages, trying to predict the ending, and ends up lost when the plot twists. A clear market gives you alignment between price, volume, and momentum. That alignment creates probability. Without it, you're flipping coins. When price is moving one way but volume tells another story, or when indicators contradict each other, that's not opportunity, that's warning. The professional sees that and stays flat. The amateur sees that and sees potential profit. And that's why most amateurs never last. I've watched traders blow up entire accounts because they couldn't sit through a sideways market. They'd enter, get stopped out, enter in the opposite direction, and get stopped again. Back and forth until they were exhausted, not by loss alone, but by the emotional drain of indecision. Trading unclear markets isn't just financially dangerous, it's psychologically poisonous. It breaks your rhythm, dulls your focus, and makes you doubt your process. You have to remind yourself clarity is your edge. When you trade in a clear market, everything feels aligned. Your plan, your entry, your exit, your conviction. When you trade in confusion, every tick makes you second guess yourself. You move stops, you exit too early, you hesitate on entries. That hesitation costs more than any stop loss ever will. Ask yourself this: what's the rush? The market isn't going anywhere. There will always be another setup, another signal, another move. The money you save by avoiding bad trades is as real as the money you make on good ones. The key is to protect your capital for the days when the market's intention is unmistakable. When the trend is strong, the market practically invites you in. It gives confirmation after confirmation, higher highs, higher lows, expanding volume. You can feel the rhythm, the flow. That's when trading feels effortless, because you're aligned with the current. But when direction is unclear, the current pulls both ways. You swim hard and get nowhere. That's not a trading environment, that's a test of patience. Every great operator knows that flat markets are the breeding ground for false signals. They lure the restless trader with small movements, then whip back and erase hours of effort in minutes. A true professional treats those conditions like fog on a battlefield. You don't charge into the mist. You wait until you can see clearly where the shots are coming from. Discipline is what keeps you alive in this business. Not your strategy, not your indicators, not your charts, your discipline. Knowing when to act and when to stand still. And if you ever find yourself staring at a chart wondering which way it'll go, that's your signal right there. If you can't tell, it means the market hasn't told you yet. The market will reveal itself when it's ready. It always does. Your job is not to rush it, not to force it, not to interpret confusion as opportunity.